Are you an absolute beginner when it comes to investing? If so, you must have 1,000 questions. What are good investments? How do you navigate risks? Are you even the right person to start an investment portfolio? The good thing is that if you are a woman watching this video, you are already set up for success, even if you're an absolute investment beginner. If your image of a typical successful investor is male, young, and broy, think again. Research from Fidelity Investments has found that women's investments outperform men's by approximately 0.4% every year. Over 3 years, women were almost 2% more successful than men in terms of investment returns. It's simple. Women are the better investors. Despite this, many women hesitate to dive into the investment world. Not investing your money is risky. If your money just sits in the bank, it will lose its value over time. Investing isn't just about building wealth. It's about securing your financial future and achieving independence. Whether you're saving for a rainy day, planning for your child's education, or your own for that matter, or dreaming of a comfortable retirement, investing will help you reach your goals. While saving money in a traditional savings account is a good start, inflation can erode its value over time. Investing allows your money to grow at a rate that can outpace inflation, helping you maintain and increase your purchasing power. We get it. Investing can be scary and risky, especially if you're an investment newbie. What if you invest in the wrong thing and lose your hard-earned cash? Where would you even begin? Well, with this video. We're your Finance Freedom friends, and today we will help you figure out where to start your profitable investment journey. Stay tuned until the end of our video for our bonus tip, where we will tell you which ETF is best for beginners. So how to approach investing for absolute beginners? First things first, you need a rainy day fund and at least some savings before investing. This fund should at least cover 3 months' worth of living expenses, ideally more. So get saving. And if you struggle with this, check out our video on money habits that keep you poor and our video on the 70-20-10 budget hack. Next, you need to know yourself and your tolerance to risk. Risk tolerance refers to how much risk you're willing and able to take with your investments. Factors like financial situation, investment goals, and personality influence this. To assess your risk tolerance, consider these questions. Time. How long can you leave your money invested before accessing it? Longer time horizons generally allow for more risk-taking. Financial stability. Do you have an emergency fund and a stable income? If your financial situation is secure, you can take more risks. Emotional response. How do you react to financial losses? If the thought of losing money keeps you up at night, you prefer safer investments. Understanding your risk tolerance can help you choose investments that align with your comfort level and financial goals. Online quizzes and tools can help you determine your risk tolerance. We've linked 2 that we like in the video description. Investing can seem intimidating, especially when you're just starting out. But the good news is, you don't have to dive into the deep end right away. In this video, we will only cover low-risk investment options, such as ETFs, because they are great for beginners. As you gain experience and a feel for the stock market, you can add higher risk options to your portfolio. Without further ado, ETFs, a beginner's guide. What are ETFs? An ETF, or exchange traded fund, is like a basket of different investments you can buy and sell on a stock exchange, just like individual stocks. Think of it as a sample platter at a restaurant. When you buy an ETF, you get a little bit of everything in the fund. This can include a mix of various stocks, bonds, or other assets, giving you instant diversification without buying each investment individually. Some ETFs cover specific regions like Europe or Asia, and other industries and sectors such as health or tech. For example, if you buy a tech ETF, it will include various tech companies, as opposed to the more risky strategy of buying one company's stock. So, why choose ETFs? ETFs are a fantastic choice for investment beginners for two reasons. First, diversification. By investing in an ETF, you're spreading your money across many different assets, which helps reduce risk. Second, low cost. ETFs typically have lower fees than mutual funds because they're passively managed. This means they track a specific index rather than being actively picked by a manager. Before we get into where to buy ETFs, please like and subscribe for more business and finance advice. We'd love to hear from you. Drop a comment below with any questions or topic you'd like us to cover in the future. Your feedback helps us create content that's tailored to your needs. So where to buy ETFs? You can buy ETFs through an online brokerage account. Some popular online brokerages include Vanguard, Trade Republic, or Robinhood. Look for one that offers low trading fees and user-friendly platforms. The right brokerage for you will depend on many factors, including where you live and how many fees you're willing to pay. Do your research and find the provider that suits you. Once you set up your account and have transferred money to it, you are ready to go. It's time to choose the right ETF for your goals. Choosing the right ETF can feel overwhelming, especially if you're an investment beginner. But breaking it down into a few easy steps can make the process much simpler. Here's how you pick the best ETF for you. First, decide on your investment goal. Think about what you want to achieve with your investment. This will help you narrow down your options. For example, if you want to invest in a wide range of companies, an ETF like the S&P 500, which includes 500 of the largest US companies, might be a good choice. Or, if you're interested in a particular industry, such as technology or healthcare, look for ETFs that focus on those sectors. Second, look at the expense ratio. The expense ratio is a yearly fee to the company managing the ETF. It's expressed as a percentage of your investment. For example, an expense ratio of 0.05% means you pay 50 cents per year for every $1,000 invested. Lower expense ratios are better because they have more of your money invested and working for you. Third, consider the ETF's performance. While past performance doesn't guarantee future results, it can still give you an idea how well the ETF has done over time. Look at the historical returns, so how much the ETF has gained or lost in the past. Compare these returns to similar ETFs to see how they stack up. Find additional information from trusted online sources. Next, buying ETFs. Once your brokerage account is set up and funded and you decided on an ETF, you're ready to buy your first ETF. Here's a few things to keep in mind. The ticker symbol. Each ETF has a unique ticker symbol. This is a short 3 to 5 letter code you'll use to search for and trade the ETF. For example, SPY is a ticker for an ETF that tracks the S&P 500. You will need a ticker symbol or ETF name to find your ETF. Next, timing. Don't stress too much about timing the market perfectly. It's nearly impossible even for the pros. Instead, focus on your long-term goals. Next, dividend reinvestment or dividend payout. Dividend investment or dividend payout or cash dividend are two different approaches to handling dividend income from investment. With the dividend investment approach, dividends are automatically used to purchase additional shares of the same stock or fund. This will compound returns over time, allows for automatic investments without effort, and can lead to faster growth. Keep in mind that although dividends are reinvested, they are still considered taxable income. You will need to report them on your tax return. The cash dividend, or dividend payout method, involves receiving dividends as cash payments. This provides immediate income for spending or reinvesting elsewhere, but may also mean you miss out on potential compounding benefits. The choice between reinvestment and cash dividends depends on individual financial goals, income needs, and investment strategy. This was a lot of information, so don't worry if you feel a little overwhelmed. Go back to specific parts of the video and then just follow it step by step. And now, as promised, our bonus tip on which ETF to actually buy. Of course, deep down, this is an individual choice and will depend on you and your goals. However, many beginners find that an MSCI World ETF is the perfect start for them. This ETF provides extensive diversification across multiple economies and sectors, reducing risk for new investors. With a single investment, you can gain exposure to a wide range of global stocks, simplifying the investment process and reducing the need for complex portfolio management. MSCI World ETFs typically also have low expense ratios, ranging from 0.1% to 0.5% per year. This makes them cost-effective. So there you investment. You are no longer an investment beginner. Don't forget, investing doesn't require a background in finance or a huge amount of capital to start. With accessible options like ETFs, you can begin with as little or as much as you feel comfortable with. The key is to start early, stay informed, and stay committed to your financial goals. Thanks for watching. Follow us to catch all our financial freedom, job, and finance tips. And don't forget, you got this.